Hey, how's it going, guys? Welcome back to mentfx, and in this video I want to talk about something that actually Wyckoff himself spoke about back in the past when he used to live, in his books and everything of that nature, that also answers a very frequently asked question by a lot of you. And the question is, what markets are the best markets to look at and the best markets to trade, especially using these concepts and all that fun stuff, right? Now, what's funny is the answer to the question is actually to trade only one market. Wyckoff himself, the dude that created all the ways of trading the specific way with accumulations, distributions, markups, and markdowns, actually said the best way to trade was to focus on one specific market, test yourself with that one specific market, learn to trade that market in and out, and then if you want to, branch out into others. So what's interesting is at the start of my journey, or what I used to do, is I'd only look at EU. Now, the reason you see a lot of different things right here, and I do look at a few other markets, is because I do lead a mentorship, and I have students, and they ask me to look at multiple things. So, of course, I am going to take a look at multiple things. However, my real education and learning in this market came from staring and learning from one market. Now, why is that important, and how is that important? The reason it's important is because you need to understand that because of the way the market moves and the way that it moves in terms of accumulations, distributions, and structure, is that every single concept and tool that is added to your arsenal and the way that you trade is going to be fractalized down to the last possible second, to the last possible tick in this market. What do I mean by that? I mean that if, for instance, you take a look at, let's just look at this impulse right here. Again, forget what pair I'm looking at. It really doesn't matter. I haven't really tested this, but I'm going to go over it to show you what exactly I'm talking about when I say this. And you can, again, do this on any pair whatsoever. So again, very simply, we can all recognize that we were in a very bullish structure, delivering price higher past these zones, past these zones, past these zones, tapping into a zone, delivering price higher again, breaking structure, creating a high, and expecting price to again trade into new lows, trade into maybe these lows here, and continue pushing higher to meet the liquidity above the next structural points, understanding that as retail gets more and more emotional about trying to find the top or pinpoint the top of a market, they're going to be ran. Now, why is it important to view one market? Because in this state that you understand this is bullish and it's breaking higher, what you're also going to find out is that when it makes the retrace, it's going to start to put in new structural points lower, and in those structural points lower and those movements lower, as you zoom in on even those, there are going to be even fractalized pushes lower that will give you even more entries that will then break structure, accumulating short term, will give you buys up that will then give you distributions that break down, potentially come right back up to retest the distributions and continue lower. And what's interesting is each one of these moves, even the ones right here that will have even smaller, tiny little moves inside them, can be traded. So the idea of studying one market, whatever market it is grounded in the fact that the market concepts and the tools used and utilized by smart money are fractalized down to their final and last second in this market. So let's see if we can see what that looks like just for the purpose of understanding, okay? So we're gonna go back here where price basically broke higher here and began to have this retrace. So what we're expecting, right, at the point that this high is made, is for prices to make a move back down into here and continue higher, even though it does not appear like the markets actually gave us a structural move down like this to get into this area. We don't recognize that we are on a higher time frame. And as we get lower, such as, let's say, the 1 hour chart, we can already see that we're gonna see exactly that, right? Prices are delivering higher, delivering higher, delivering higher, delivering higher. And as they begin to break structure, based on the previous videos that you should have seen, we already, right, with the break of structure that occurs right here, right, overall in this whole thing, we already begin to anticipate that not only are we going to make a run for the, demand zones in here, but we're going to begin to run the liquidity below where? The inner term lows, 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 and lows. So we know that there's going to be an entire move on all these lows. And what's interesting is if we just draw out a line at these lows, you'll notice something very interesting about the way they were cleared. Okay, let's draw a line on all these lows. Notice how these lows were cleared. Price approached lows very quickly, stopped, came up. What is that? That's incentivization for retail or emotionally unsteady people or people that are afraid of missing out on a move, getting involved on the engulf, on the inside patterns inside here, because remember, this is a 1 hour chart, which means on a lower time frame, what's in here? A lot of movement higher, right? Especially if they're looking at a 1 minute, this is going to look like a very strong 1 minute push up. Gets cleared. As it approaches this low, what does it do? It creates another liquidity area and again creates even another liquidity area. Again, doing what? Pushing higher with an engulfing candle. What does that mean for a lot of retail or emotionally unsteady people? More buys. Pushes right through them. What does it do before coming through this area right here? It stops. Gets people involved. Pushes up. Takes them out. Again. Stops. Pushes up. Stops again, making equal lows on a lower time frame. And then taking them out. Tapping into the last possible area we were looking at to be a possible demand zone for prices to be given to us higher. Now, why is this all important? Well, because in this, even though it might not look like it, there's actually going to be a ton of opportunities still get short inside all of this. And even though these areas function as liquidity, they also function as short-term demand zones, especially those are left unmitigated. So if we, for instance, looked at this area right here, right, and you notice that it had a mini mitigation here, this is still an area that could give you a buy that still could run 6RR, 10RR, something of that nature, because we are on a 1 hour chart. You need to recognize that looking at one chart is enough because there are still fractals inside of here that will give you a move that will take you higher. How so? The second we get down to a much lower time frame. Okay, shit, so we can't actually get that low, sadly. Let's go and look at something else very quickly. Let's take a look inside of here, for instance, okay? Look at this demand zone right here. We can all agree that this is a last down move before some kind of up move. Now, even though we are bearish on this overall, looking for it to come here, right? Back from when this impulse was made, due to the fact that this was a break, and we looked for it to come here. Back when we anticipated that, we also could see that this was an unmitigated zone, which means that we know that on the way down, more likely than not, there will be mitigation here. But this mitigation won't occur for the purpose of much higher prices, but will instead occur to basically create liquidity before running more lows to hit the real areas of lows, especially since we had to run all these lows right here, which, by the way, you could probably notice using the fixed range tool, which I talk about in my volume profile video, which is about an hour long. So make sure you check that out, right? Notice this impulse. Where's the lowest volume? Right here. If we draw that out, what do we see? Liquidity, 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 liquidity. What happens? All that liquidity gets ran. Where does it stop? The higher volumed areas, right? And that's where it begins to take off again. So with that in mind, right, on the way down, we still can use these areas if we are day traders to look for buys inside here. How so? Well, the second we get down to a 1 minute chart, notice what you actually start to see in here, right? Price comes down and begins to transfer weak hands and weak hands, right? Equal lows to the strong hands. This is strong hands getting involved and breaking structure higher after undergoing a form of Wyckoff. If you do not see the Wyckoff, let me label that very quickly for you, but it's probably going to be seen a lot better on a 15-second or a 30-second chart. But what you have here is a selling climax. Let's make this a little bit smaller. Let's go to 12, right? A selling climax, an AR, right? An ST, testing the low of that selling climax, an STNB, also known in this case as a spring, due to the fact that this is a type 2 accumulation, right? The sign of strength that looks to break the market higher, right? And based on the previous video where we spoke about the fib levels and how to utilize them the best way, you could have taken the last down move before the up move, right? And already it is a low time frame, so probably the open would be the better area to look at. But if you had used the 50, that's your best refinement. And already you can see that wick rejections are occurring in this area. Now, similarly, if you were still unsure about trading this overall schematic, right? Because this right here is a Wyckoff schematic as is, and it's perfectly valid on all levels, on all fronts, whatever, to go long. If you were still unsure about this schematic right here, right? So let's go ahead and save that. Wyckoff, so we know. Then you could go ahead and confirm that same 50%. So as you start seeing these wick rejections, you go, okay, there must be some rejections here. So either you're already happy to go long because you're seeing that the wick rejections are occurring at the 50%, like we spoke about in the previous video. So utilize this 50%, very powerful. Or you dive deeper. How do you dive deeper? You jump down to the 15 seconds, right? Maybe even the 5 second here. 5 second, there we go, right? And what do you see once again? Well, as price is coming down, you're seeing this stopping action, right? That stopping action is being met with what? Selling climax into your automatic rally, into your secondary test. Testing, again, the demand zones of the selling climax and doing what? Creating intermediate term lows right before the 50% mitigation of the demand zone, right? Breaking higher, coming to make what? Equal highs, or also known as a sign of strength in phase B. Something we teach in the mentorship. And again, if you want to be a part of the mentorship, it's only available at this website right here, launchpass.com/mentfx. Please do not be scammed. I do not offer it anywhere else. I will never ask for your money because there are a ton of Telegram groups that are now scamming to be me. Anyway, after this, we have the move down that liquidates these and creates the ST and B. And now again, do you see structural breaks? No. Instead, it comes down and makes the final spring. Similarly, let me ask you, what happens after that? We finally see structural shifts in the market, which move the market higher and break structure higher, creating what in the market? A real sign of strength. And what do we expect? The tests and the LPSs to come in. Where can they be coming in from? The last down move before the up move. Now again, because we're on a much lower time frame, we do not want to take the 50% of this. But again, let me show you, if you did take the 50% and you began to watch this, wick rejections, moving higher. Wick rejections, moving higher. So you know what can you do? You're making demands on 2.0s. And that's where you can look to be a potential participant off of. So if you wanted to confirm that exact same zone, that's how you would do it. But again, the reason I bring this to your attention is because we are on a 5-second chart right now, watching price deliver to us the exact same way that it delivers to us on a higher time frame. The idea here is if you stick to one chart or one market, you can master it to the point of the last 5-second chart. And what's even more interesting about this is if we went and looked at this on a 1 second, we could probably see an even more fractalized accumulation in there occur, right? Now this is very small, but notice what you see here. Once again, okay, as price delivers lower, honestly at this point, I don't really see it. There's no drive down, but there could have been a selling climax, AR, pretty much AR, ST, sign of strength, and in this case, we did not make a liquidation of these lows, so I wouldn't count this as a schematic itself, right? But that is one way to view schematics across all timeframes. Notice how this schematic right here, right, is no different from the schematics that you're used to seeing on a higher time frame. This schematic right here is the exact same schematic that you see right here, right? All it's doing is the test of this schematic is actually shown to you fractalized, because that is how the market will move. So if you understand this, then what is the purpose of having to go and look at multiple markets if you know that you can get involved on the miniature movements of these small markets, right? And the reason I make a point of showing you this is because despite the fact that, remember, we are right now trading in an area that held for less than 1 hour. Now, despite that, that tiny mitigation of that overall zone still delivered to you based on which buy of these you took, whether it was the buy that was delivered to you at the 50% of this overall original schematic, which ran about, again, we didn't catch it to the very high. If you did, which ran about 4RR, or if you waited for the ultimate confirmation to get involved on this, then the schematic at the 50, so I mean, the 50, it's just insane, right? We're not going to actually suppose the 50%. Let's suppose the open because that's pretty normal. Stop loss right below the low. Again, not affected by spread because you are in a buy. And if you're in a sell, please factor in the spread for your stop loss, right? Extend this out in time. And again, as it goes higher, you're going to be partialing, of course. Runs a total of about 1 to 30. But again, you're going to be looking to partial at new highs. Understanding that this is liquidity. Partialing at, again, areas of supply, which will actually act as areas like this. So you have a little bit of mitigation here and continuing higher. And what's interesting is if you zoom in and view price with basically a zoomed in version of what's going on here, you're going to see fractalized distributions being delivered to you, breaking of structure, and testing the last up moves before the down moves. Actually here, I don't think it tested. Let's see. Actually, so it did. So again, I ask you, is this move out of nowhere, or is there a reason to it? Well, it's the last up move before the down move. And if this is a distribution that you're watching, there are opportunities to get in short here to then continue on the large markdowns. And this is how you can day trade back and forth. Now, again, I take you lower and notice how even in areas where you don't have confirmations, there are still weak hands and weak hands being transferred into the strong hands and moves higher. Now, when this happens, you're not always going to get a pullback and an area to get in on. And sometimes the markup will happen without you, and that's fine. because what will happen in the future, you'll have markdowns again, right? You'll have more accumulations, which come to give you more distributions, which come to reaccumulate, which come to distribute. And again, this is all still in the span of less than 1 hour. So the idea behind this is that every movement in the market can be fractalized to the point of either being a markup or a markdown from a Wyckoff perspective. And if you understand how Wyckoff looks, or you're in the mentorship and you've gone through the private course on Wyckoff and understanding how to see it, then even the tiniest mitigations of an imbalance, such as this area right here, right, at a certain zone like this, can still give you ample opportunities. Now, if this is too large of an area, again, recognize that you can go and refine that. I've never done this. I haven't refined this, so let's see if we can do it. But if you go in here and look for the last down moves for the up moves, you'll notice that the last down move for the up move actually exists right here. Now, what do you notice about that move? It actually was what? Mitigated. So if we use the same tool we've used in the past, where we take the 50% of a zone like that and use that as the refined zone that has not been mitigated yet, then we potentially have a zone where we can look for buys, right? And this is how you get fractal and very low time frame confirmations on certain price action, because you are basically looking at the last possible area of rejections and then studying those rejections in confluence with Wyckoff. So in this case, as you can see, if you had gone the extra step of refining it, you wouldn't have gotten an entry on this Wyckoff right here. And also, when it did mitigate it, notice the type of mitigation it had. There was no entry for you to take, even probably on a lower time frame, such as a 5 second. Let's take a look at that, right? Notice what occurred here. Prices come in. Does it ever undergo a real Wyckoff distribution? No. The Wyckoff distribution that was occurring here was occurring from here, taking out lows, and basically this actually acted as the place where you'd want to see confirmations to then go long. But due to the fact that it's never basically broken it and confirmed your overall accumulation, if this was a spring, it continues to break down. And that refined zone, which you've now used, again, can be on a 5 second or any low time frame and show you that you can't get involved. And again, the purpose of me showing you this is to understand the price delivery of a market, any market you look at, whether it be AJ, whether it be Verizon, Tesla, a commodity, an indices such as US 30, Euro US dollar, anything is going to be fractalized down to the last 5 second, 1 second chart that it can possibly get to. And those charts will still undergo the same type of accumulations and distributions that you see on much, much higher timeframes, right? With the same type of accumulations, you know, weak hands, equal lows being taken out, structural shifts to the top, right? Come to test the last down move before the up move, and the continuations higher. That exact same Wyckoff schematic in here, right? So if we are to go like this, let's delete all this stuff right here. That exact same schematic right here on a 4-hour chart, which we can view as you all remember, selling climax, AR, ST, or ST, either one, right? STB / spring, right? Sign of strength, as we always see, breaking above and validating the schematic. And then the test that comes to take the market significantly higher off the last down move before the up move, right? If we take a picture of this very quickly, just like this, okay? Take a picture of that, it's copied over here. And this is, by the way, how you should also backtest to understand exactly how the market is moving for you. If we take a picture of that, right? That's a 4-hour chart. And then we go and find our, we go inside of here and we go and take a look at that on the 5-second chart very quickly. Let's go inside of here. Let's go find out where that was. Zoom out here. And we go ahead and zoom in on this. This is a 5-second entry, right? Spring, let's actually not use the 50%. There we go. That's your demand zone, right? Just like that. And here's your test. 5-second chart. We'll take a picture of that. Go ahead and paste that in here. Now let's go look at a 1-minute chart very quickly. Zoom out on that. There we go. Go over here. Let's delete this and let's delete all of this in here. Okay, let's look at the last down move before the up move. Right here. Okay. Again, what is this functioning as? The test. Okay. And that test is again the 50% or the open. Either one is fine. Take you higher. Okay. So again, we'll just get rid of that. That schematic. We'll take a picture of. Okay, that's a 1-minute chart. Put that in. Let me ask you now what we just looked at. we just looked at a 4-hour accumulation, which was a type 2 accumulation, selling climax, AR, ST, STB spring, SOS, test, continuation. A 1-minute chart that did the exact same thing on the exact same currency pair, selling climax, AR, ST, STB and spring, the sign of strength, the move right back down to the test, okay, continuation up. And the 5-second chart, the selling climax, the AR, the ST, the STB, the spring, so in this case a much longer one, but you could have also looked at this as an STB/spring, the SOS, move back down to the test, the markup. Every single one of these is taken on the same exact currency pair and showing you that it can be fractalized and looks the exact same way across all time frames. Understanding this is what actually then moves you to then study one market for the movements of it intraday, intra-week, intra-month, and see how all of them correspond to each other and how all of them act together to deliver price in a certain way. Once you understand that, then you are able to take your knowledge and your understanding of a market or a way to analyze the market to absolutely any chart and understand that it will be delivered to you the same way across all time frames. And then you'll notice that there's distributions that are met with accumulations in areas of previous accumulations that are met with new distributions, smaller time frame distributions, smaller time frame distributions, smaller time frame distributions that take you into large cells, meet you into accumulations that become smaller time frame distributions into smaller distributions, so on and so forth. And the market is delivered to you on a fractal basis the exact same way across all time frames. The best strategy is one that can be employed on a weekly time frame, the same way it can be employed on a 1 minute and 15-second time frame. The only difference is going to be commission costs and spread. But to understand a market in and out and to study one market and understand every single move in that market and how it corresponds to a higher time frame move is what will allow you to take your understanding to a new level and to trade in these markets and any market that you so please. Okay, so hopefully, and again, let's actually take a look quickly on a Euro USD weekly for the purpose of explanation or for the purpose of finality, right? And what you'll see again is the exact same thing we've just noticed. The selling climax, let's make this a little bit bigger, okay? Let's go like this, the selling climax into the AR, okay? Or you could take this as the AR, doesn't matter, into an ST, okay, into a UT. Let's not actually get into the full-on schematics. So let's make this really easy. AR, ST, into an STB. That also acts as what? A spring, okay? That goes up into what? The sign of strength, showing you that it wants to go higher. You find where that came from, the last down move before the up move, right? And that comes to make the test, which again, we'll actually view on a monthly to make it much easier to see. There we go. A very simple schematic. Draw this out. And again, what are we in right now? The markup that is most likely doing what? Coming to take the liquidity here and come to trade up higher, okay? Now, we'll take a picture of this. Paste that in here. And again, I'll ask you, what's the difference between this? Let's make this a little smaller. This. Where is it? Oh my God. Getting them all lost now. This one too, nice, and this. Okay. Okay, I'm doing a poor job at showing this right here, but if you take a look at everything that's on my screen right now, even though it's ugly as can be, the 1 month accumulation, the 4-hour accumulation, the 1 minute accumulation, and the 5-second accumulation all act the exact same way, follow the exact same parameters, follow the exact same breaks of structure, and return to their demand zones that caused those breaks of structure, then being met with the markup. And that is how you use the fractalized nature of the market to understand every single market or to trade only one market. So there is no one market that follows this any better than anything else. All there is a market that will undergo this on a fractalized basis every single day, and that you can use to line up with areas of confluence, with areas of POIs, with areas of supply and demand to predict potential mitigations and get involved on the breaks higher, the retest, and the continuations on the markup. And again, this is all perspective based, so please do not go and lose all your money unless you test all of this stuff. And if you want to get deeper, feel free to join the mentorship available only at this website. Please do not get scammed. There are a lot of fake websites and fake telegrams. that pretend to be me. And that's pretty much it. Thank you so much for watching, guys, and I'll see you in the next video.